My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today we got a very experienced operator on Zoom with us. Jay Biggins is zooming in from Florida, and Jay and his company have done a lot in multifamily real estate. So we're going to talk about that and what his secret sauce is. So Jay, welcome to the show. Great to have you.
Thank you. Appreciate it.
Great to be here. So Jay, give us a little snapshot of what you invest in and what the primary markets are, if you wouldn't mind.
Sure. Well, I kind of like that question because I have free market. I'll go wherever I can get the right return. If I had my druthers, I'd do everything in South Florida. But cap rate compression and lack of yield in South Florida has made it just about impossible. So probably the last 7 or 8 properties we bought have been in Texas. Then prior to that, probably a few in Ohio. We have North Carolina, South Carolina, Virginia, Tennessee, Alabama, Mississippi. So I think those are gym markets we're in the moment, but I'll go anywhere. We had a for a little while. We did Indiana a couple of years ago, wherever I can get the right yield.
Okay. So what does the right deal look like for you? What's your buy box?
Well, I don't like to be painted with any certain brush.
Okay.
My buy box is whatever I can turn a nickel into a dime. My favorite type of buy box would be no heavy lift physically, but an operational lift.
Right.
My favorite buy box is, hey, the place is full. It's just undermanaged or mismanaged. Then I go in and either fix just whether it's rental rates or do some cosmetics or whatever it is to get or lower expenses, just to have a property operating at peak performance.
Mm-hmm.
But of course, we do heavy lifts also. I just find that the yield per headache is much worse on the physical heavy lifts than they are on the management lift.
Of course. No, that makes a ton of sense. So you've got a lot of properties over a lot of different states. Do you tend to work with co-GPs on different projects? Do you work with folks that are local there? How do you manage everything from afar?
One of my favorite topics.
Yeah.
There's a big, I think, understanding that when you buy a property that's not within 2 hours of your home, you really are going to need third-party management, which I totally do not subscribe to. We self-manage in every location, other than a couple of HUD HAP projects we have. We don't self-manage those. But other than that, we manage across new markets throughout the country. And new markets is part of our core business. We're always going to new markets. Mm-hmm. So I just think that when you hire a third-party manager, the minute you stop managing that third-party manager, you have big trouble. They're going to eat your lunch for you. So you might as well just manage your own manager, and it's, just brought in-house, and you have one less middle manager, and that's what we've done all across the country. So
okay, so you're focusing on properties that are big enough to support a full-time on-site management or manager team.
Most in our business would argue that our properties are too small for their own manager, but I just don't think that that's actually true. We have a lot of 40 and 60 unit properties.
Okay.
100 and 200 unit properties also. But I compete against players that, drive the yield right out of those investments typically.
Right.
So, we do buy a lot of smaller assets just because we have been able to get better yield, and we're not syndicating, and, no, I do not have any co-GPs. Yes, we don't do any capital raise or anything like that, but we just find that bringing everything in-house has been a cost savings because we feel like the third party management is death by 1,000 cuts. No one thing eats your lunch for you, but
interesting
items, it really does.
So do you try to buy a couple of smaller properties in the same town, the same city, and get some efficiencies that way, or you just plunge
anywhere for the right deal at the right price, and I don't care if I have any operational efficiencies or not.
Okay.
The least operational efficient thing that you can do is overpay. So as long as I'm not overpaying, as long as I'm buying right, I'll go to any market. I won't go to any market for like 24 or 32 units, but I'll go as long as it's a minimum of like 40, and I really would prefer that to be 64. But I'll go to a market for the right price on a 40 unit, even if I have nothing else in the area.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. And then you're mentioning that you don't raise capital, you don't bring on co-GPs, you guys do all your own thing. So you self-finance everything, is that correct, Jay?
Yes. I have a partner or two that I work with over the years, and we haven't run out of our own investable cash. So, we do tend to turn assets over, so it recreates new cash on the regular. So we just haven't, right, wrong, or indifferent, we just haven't gone down the syndication path.
Well, probably a very good thing, especially considering what's happened to a lot of other syndicators over the last couple of years. Have all of these, headwinds other people have been facing affected you guys at all with your portfolio?
We've had record years.
Nice.
22 was a record, 23 was a record, 24 was a record, and 25 was a little bit different type of record. Our transaction volume was maybe down 10%, but revenue was up. So, it was financially a record year, but just on volume, it was maybe down a little bit.
Very interesting. So, Jay, when you're buying properties, what's your typical exit strategy on your deals?
Well, I try to let the deal determine my exit strategy. I always try to do right by the asset, no matter what that is. And even when we have an asset that's pending sale, you have to keep spending to keep your asset up. And just because you have a pending sale, if you think that you can really stop doing the right thing by your asset, and that close was going to take place and you're going to be kind of home free, I think that's what we like to call stinking thinking. If you maintain your asset all the way through a closing day, those are the things, even with whatever financial upkeep and CapEx you might not otherwise want to spend because it's pending sale. If you do those things, those are the type of things that ensure that sale goes through. And if the sale doesn't go through, then your asset's in just a better position to move forward. But in terms of overall market conditions, I think we're in a really good time right now because when the market was just vertical and cap rate compression was a thing every day that passes, it seems like cap rates were compressing lower and lower. It's really hard to buy anything that was going to be a long-term good investment. I mean, you see what happened, rates ticked up. And insurance rates ticked up, and it was kind of a slaughterhouse. But in times like this, right now, we have deals that you can buy that are going to, depending on what your strategy is, you can buy a good coupon clipping cap rate and just operate it long term, or you can buy something that's got some value add component and make your way. And then if you're a seller, it's really actually a pretty good time to sell as well. The thing that makes our market a little challenging, and people would argue that, hey, it's not really a good time for seller, only for sellers that pay too much, 2 or 3 or 4 years.
Right.
But if you're not underwater and you're in a good position from when you bought it, it's a very good time to sell. So it's a good time to buy. It's a good time to sell. I find a very good market. It reminds me a bit of the years between maybe 2011 and 2015 or 14. Once you got 15, 16, 17, it just became a very strong market. So lasted for quite a long time. But it reminds me just before the really bull market. And we did well back then as well.
So, Jay, it sounds like one thing that, well, you're doing a lot of things right, but one thing you must have pretty well dialed in is sourcing properties, sourcing opportunities and deals across multiple states, multiple different markets. What do you find works best for you guys for finding good deals these days?
Man, that's the question everybody asks. Like, how do you find your deals, right? And that's how the money's made. Really. I mean, I don't ever sell anything for more than what it's worth. I can only sell something for what it's worth, or maybe slightly less than what it's worth to get somebody to buy it. So it's really all about buying right. It always has been. And I think generally everybody knows that in the real estate business. But it's less about how we source our deals and more about how we see our deals and how we see the assets we invest in. Because it really comes down to everybody's individual strategy and what you have tolerance for. And we fix problems for a living in multifamily housing. So we'll take on all different types of challenges. But if for us, whereas other people might view our investment a risky investment because maybe it's not stable in the moment, we view it the other way around. When we do sometimes sell these off, we feel like the upside maybe is not quite as frothy. So we find that there's risk maybe in a fully stabilized asset that doesn't exist in something that is currently destable. So I think it's less on how you source and so much more on how you see what it is you're going to invest in and what your strategy is and executing on a plan. And there's no right or wrong. It's just a matter of what your strategy is and executing on it.
Yeah, no, that makes a lot of sense. So do you guys do a lot of off-market deals or primarily broker marketed type deals?
We do some off-market deals. I mean, everybody wants to buy off-market, but it's funny. There's a portfolio that's been circulated around in Texas, and like I've been looking at it for a year and a half, and everybody's seen it. It's been marketed and marketed and marketed. And then somebody finally bought it, and they were like, well, we only bought it because it was off-market. Oh, off-market. Maybe it wasn't listed, but it's been around for the better part, almost 2 years. So I don't think it matters whether it's on market, off market. The perception is that it's off market, it's been shoved out, but that's just not true. Almost everything we sell, it doesn't get listed. So those are technically off market. Doesn't mean we didn't shop them a bit. Doesn't mean we didn't call the best 3 or 4 brokers in those regions. But I don't think that there's value to be had just because something is considered off market. And quite honestly, I think it's the opposite. Brokers are a resource. They're a very powerful resource, and I want to use them every opportunity I can, whether it's on the buy side or the sell side. I may not list an asset, but I definitely use brokers to exit, our dispos.
Yeah. Well, as we're wrapping up here, Jay, we're early days still in 2026. Where do you see yourself and the company going over the next 12 months or so?
Happy buying. We're on definitely a buying spree. If I could add 3,000 units over the next 12 months, I would love that. I don't know as a practical matter whether I'll be able to do it because we are pretty disciplined on what it is we're buying. But I think it's a great opportunity to increase portfolio.
Fantastic. Jay, this has been great. Thank you very much for sharing some of your insights. You've been around the game for quite a while, and you guys have got a model that's working really, really well for you. And I think a lot of people would be kind of envious of that at this point. So if people want to connect with you, find out more about you and what you guys do, where's the best way for them to go?
Our website is multihousing.com, and I imagine there's links on there where you can either email or give us a call.
Sounds good. Jay, thanks so much for being on the show.
Thanks, bud. Take care. Appreciate it.
Thanks for tuning in, everybody. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.